Hello everyone, welcome back to another exciting webinar session hosted by Gwalior Smart City Incubation Center. I am Nika Upadhyay, your host for today's session, and I am delighted to have all the founders, entrepreneurs, innovators, and participants joining us today. Today we are here to discuss a topic that is extremely important for every startup's growth journey, which is building investor-ready financial model. As we all know that every startup has a vision to grow, scale, and attract investors. But along with a great idea, having a clear financial roadmap is equally important. A strong financial model helps startups understand their business plan, growth strategy, and build confidence among investors. And to help us to explore this important topic, we are pleased to have with us Mr. Ravishekar Kalepu, sir, Director of PR GTM Venture Private Limited. With over 15 plus years of experience in the startup ecosystem and 30 years of experience in IT, he has been actively working with startups to define their business goals, build feasible financial and business models, and design effective growth strategies. His passion for helping startups grow and scale successfully brings immense value to today's discussion. We are truly excited to learn from his insight, experience, and practical understanding to building strong investor-ready financial model. So, without taking too much time, let's warmly welcome Mr. Ravishekar Kalpe Susa. So, welcome, sir.
Thank you very much, Mega, for your brief introduction about me. And today we have chosen to have this building investor-ready financial models as a topic. But I want to say the models are not only very specific to investor, for any company or any startup. When we are trying to build a startup or a company, we need to have a financial model ready for us. In order to have that, we need to understand what are the ingredients which go into it for a financial model to be ready. For that, we consider revenue, the cash flow, which is coming in and going out. What is called the unit economics means when we are trying to sell a product, what are all the stages it goes through, and from all these, what is the expectation the investor will have tomorrow when we are going for funding of our startup. We need to take all these into consideration when we are trying to pitch to a investor. Investor looks at not only the financial model, he wants to understand the growth strategy of your company. What is How is it growing quarter on quarter or year on year? What is the burn rate which it is having? What is the cash inflow it is having? Like, what is the sales revenue? What is the projections in the future years? These are all the things an investor looks at before even trying to say yes to your pitch to fund it. Okay, with this, we'll get into an agenda of what are the needed things to how we can prepare a financial model. The agenda for today has introduction to financial modeling, the financial model fundamentals, revenue projections and cost planning, cash flow management for startups, unit economics and business viability metrics, investor expectations from financial models, building an investor-ready financial model. Introduction to financial modeling. When we say introduction to financial modeling, here, what are the ingredients which are needed for a startup in order to do a financial model? Why are we doing this? If we understand this clearly, we can create a financial model very seamlessly with all the required ingredients so that tomorrow when we are pitching our startup to an investor, he or she will not have any further majority of the questions addressed because you're already trying to address all the questions what he has in mind. Means how are we coming to fundraise this particular startup? What is that we have already done? What is your past performance? How are we tracking? All these things we showcase to the investor by whatever the tools we have used. Like when you're trying to forecast our growth and expenses, we try to understand what is the sales forecast we already have, what is the sales pipeline we have. Based on that, we track it month on month. Initially, in the initial stages of our startup, we try to track it month on month. Why we track on month is to understand, to realign the projections as per the entire funding requirements tomorrow for tomorrow. When we say a month-on-month growth, if we this month if we have done 50 units per month, next month if we are growing by 75, we see a 50% growth. But that 50% growth cannot be consistent across the 12 months. It can go, the very next month can go from 75 to 100, and the fourth month it can go up from 100 to 150. It's again, it is a 50%. See, that change we should clearly showcase in our consistent pattern in the month-on-month growth. That is when the investor gets the confidence. If we show a sudden increase of from 50 units to 500 units the next month, then the investor will have his own doubts whether it is a concocted one or the real sales figure what we have in it. So we need to be very clear in doing all these things from day one. If we are really having a 50 unit to a 500 unit jump, we should be able to substantiate, tell that why that difference, big difference. What is that which made that, bring that 10 times difference to the organization. That we need to be able to tell that. That is called measurement, business sustainability measurements. These which we take into consideration, that is when the investor will have the confidence. It is not just putting the numbers into the spreadsheet. It also should give a consistent behavioral pattern in your journey of your month-on-month or quarter-on-quarter growth. Okay. The next thing, when you are looking at the fundamentals of financial models, the revenue model, cost structure, cash flow, profitability projections. What is revenue model? How the business earns money. That is where we have already discussed about the sales plan. Once we have the number of units sold, we track that. And once that is known clearly, we know what is the price we have allocated to it. And based on that, we understand what is the cost per unit. Cost per unit, when we identify that, we know what is that revenue which is coming in, cash inflow. And the next thing, when we are running any organization, we will have expenses. Expenses can be of two types. One is fixed, one is variable. Variable expenses is like your day-to-day expenses for the organization, like daily commute, for travel, to sell, for the sales guys to do the sales and marketing thing. At the same time, office expenses. And there is, when I say office expenses, the office rent will come into the fixed. But the office expenses, the day-to-day expenses may vary. Sometimes there can be some guests who come to visit our office to check our entire manufacturing plan or a process flow plan. In order for that, when we entertain the customers, that is a variable expense which we spend there. And the fixed expenses are like having a computer or having some physical assets to prepare your product. That is all goes into the fixed assets, which is more of a fixed expense. In cash flow planning, you will see money coming in and money going out. What is money coming in? When you sell a product, your money is coming in. When you purchase raw material, the money is going out. That is also one of the expense, but is a trading expense. There's a difference between a trading expense and a trading profit and loss expense, right? That is the difference between money coming in and the going out. In the going out also, there are multiple expenses, which are, one, the cost of raw material goes into the trading expenses. In the profit and loss account, there are other expenses like your office expenses, your salaries, your other miscellaneous expenses, all go into the other profit and loss expenses. How do we arrive at the profitability projections? We need to understand the revenues. What are the revenue? What is the revenue coming in? What is the expenses we are taking off? And from that, we also deduct on if there are some fixed assets bought. We need to give depreciation for the particular financial year. Then whatever is left over is called the profit, which we showcase in the balance sheet. Okay. And in order for what is the key assumptions to arrive at the pricing is basically we can see growth rate, your customer acquisition churn, which is how much you are spending month on month. If you are earning 100 rupees, but your spend is more in the initial days, you might be spending more than what you are earning for any organization or a startup or a company. That burn rate may be high in the beginning days, but as we progress, the burn rate comes down. The number of products you sell more, the revenue increases. And at that time, even though the standard expenses, which are more like monthly expenses, will be there. Those will be the same, but there will be a slight variation in the monthly expenses on this side. The revenue of the number of products sold will be, when it is more, that revenue income which is coming in will be high, and that's where the burn rate or the churn rate comes down. Okay. Understanding revenue projections. This we already talked about the pricing strategy, how the customer growth happens, sales volume, market demand, and transaction model. See, pricing strategy, when we define any manufacture or create a product, we know there is some raw material or there is some service which is going into it. For an IT company, there is no raw material. It is the human labor which is going into it, which is the salary. Majorly, the salary, the real estate expenses, the office rent, office other expenses, all these things. When we are doing a pricing strategy, at that time we need to consider all these expenses into account and then price your product. It is not just the raw material and the development of the product doesn't only go into it. We also need to consider all these expenses which are going to be more of a standard in nature. Those also we need to consider when we're creating a pricing strategy. Then based on that top of that, if you add profit, that will give you the right ingredient for you to grow. Else, you don't consider the expenses rightly and consider that into the pricing strategy, you will have challenges in the growth. Okay. And the customer growth here, in the customer growth, when we are trying to create a product or a service, we need to have a consistent strategy to maintain the product or the service. If you do not maintain the customer, there will be a customer, one-time customer. If the product or the service which we are creating and providing to them is authentic and have value to it, there will be a repeat customer. So the lifetime of the customer increases, right? And the cost of acquisition of the customer also reduces, because if the same customer is coming multiple times to us to buy the product or the service, at that time we say the lifetime value of the customer is increased. When we get this, the churn rate on customer acquisition is coming down. Sorry. Why? Because the same customer is repeatedly coming back to us to buy the product or the service. Okay. And the sales volume. See, here in the initial time when I was talking about the projections and all that, this is what we need to maintain in the month-on-month spreadsheet, which we say what is the sales we are trying to do in a particular month versus the next and the follow on. This, if we track it, we understand what is the growth percentage we are doing. If we have this rightly, we understand based on our sales, we can understand how we are growing. The percentage in terms of growth, we can understand that. Based on that, based on our sales funnel, we understand what is the market demand which is getting generated to us, right? With that projections only, we can say this is what in the first year we are making 100 crores. In the second year we are trying to touch 250 crores, and the third year we are going to hit 500 crores. That is what we arrive at based on the proper spreadsheets, what we are any other tools which we maintain to track our sales and the expenses chart to understand one, sales to understand the revenues, two, in order to understand the burn rate we need to maintain the expenses sheet also in the right way. Then we can understand the churn rate also, the monthly burn rate also, we can get it rightly. And the last one, the subscription or the transaction models, it all depends for any service or a product. When we are trying to sell a product to a customer direct, if it is a B2C, we do a subscription model. When you're doing a B2C, more of a subscription model works because the price of the product may be higher. In that case, what we go with the subscription model to attract customers, giving them planned subscriptions. Okay. In a transaction models, basically we try to sell products individually and where the cost is optimal. Like your cell phone, the iPhone, when you're trying to sell an iPhone, you cannot do a subscription model. But at the same time, when you're using any SaaS application, there you cannot sell the SaaS application as a product directly, where you try to sell that as a per use per month or per use per day or something like that. We try to plan it accordingly so that the customer is not pinched at once at a big time. Okay. Here, when I was talking about the revenues in our earlier discussions, how a revenue is calculated, basically the customer number of customers into the average selling price of the product, it gives you the revenue. See, cost and expense planning, this is what we discussed already. The fixed costs are salaries, office rent, software subscription. But in the variable cost, manufacturing cost, because today, 1 month we are doing 50 units, the next month you are doing 100 units, the third month you are doing. Based on that, your marketing spend also differs. Your delivery and logistics differs. All these are some of the examples we have given, but there can be multiple variables which can come into variable costs at the same time in the fixed cost also. These are the two different variable costs and fixed costs which can be coming in the cost and expense planning, which is nothing but the profit and loss account which I was talking about. Okay. The cash flow. In the cash flow, I was talking about only the products. Here, see, here the operating cash flow, day-to-day operations, investing cash flow, which goes into the assets and investments, and financial cash flow is funding and loans. These cash flow is different from the sales revenue, which we are talking about. Operating cash flow, these operating cash flow, day-to-day operations, which we try to use it for our variable costs, and in investment cash flow is basically for your fixed assets, like your computers, like any website subscription. All these goes into this. And financial cash flow here in the fundings and loans, when we're trying to take any debt from the bank, that is a banking loan which comes into this financial cash flow. Or if you're tomorrow when you are at a growth stage, you want to go to the investor to get funding, that also will be shown in the financial cash flow. Okay. I was talking about unit economics. Unit economics is nothing but, first we need to understand what is the cost of acquisition of a customer. See, sometimes we can, based on the product which we give to the customer may get onboarded with less cost. In some services where we need to sell the product and we are unable to convince the customer, there the cost of acquisition goes high. that is where we need to understand. Once we are increasing the cost of customer acquisition cost, the LTV should be longer. If the CAC is high, LTV if it is low, then you will have a bad impact on your profit and loss, which is your gross margin. There you will get impacted. If you are healthy, if your CAC to LTV ratio is good, which is CAC to LTV is higher, LTV is higher than the CAC, then your health indicator is pretty good. That is what we are showing it in the health indicator. LTV should generally be higher than CAC. Okay. The metrics for investors track. What is that? Revenue growth rate. When the revenue growth rate is high, we can see the gross margin. We can understand the gross margin from this. And from the gross margin, we remove the burn rate. Then we get the actual money for runway. How much money is left over for next futuristic months? That is the runway which we are looking at. Once we know the runway, based on that, we can we will understand how many days we can sustain with our own funds which are available with us. The customer retention rate is always should be high in order for us to get a better monthly recurring revenue. If we don't have the customer retention rate high, the monthly recurring revenue will be this will go up. Why? Because the cost of acquisition is going up and the customer acquisition rate is very low. If that is low, the cost of acquisition of the customer is going high and the recurring revenue will be more. Monthly recurring revenue will be more because the number of products we are selling is less, but onboarding the customer cost is going high. That's where we will find the the revenue, the expenses are high, and the customer churn. When the retention rate is low, the churn is automatically there, and because of which the profitability gets impacted. Whatever the EBITDA, which is earnings before income tax and depreciation and all that will have an impact once we have a higher customer churn or a monthly recurring revenue being low. If these two are the customer churn is high or the monthly recurring revenue is low, then it will impact our EBITDA. Okay. What investor expects from financial models. This is very clear why when we are creating our financial model, I told you, we need to track it very clearly month on month, every expense, so that the investor understands the revenue inflow and also the burn rate. The burn, he will understand from the expenses what we are spending. That is where that's the reason we are very clear and saying that clear and structured financial model should be organized, easy to understand, logically presented. If we put it in a month on month or a quarter on quarter projections clearly to him, the investor will understand that yes, there is a consistent growth. And if we show it in a pie chart or a bar diagram, it will be easy for him instead of the numbers. That is more easier for the investor to understand. What are the assumptions you are trying to take? We need to be clearly define that in the business. We need to say why we took the assumptions. What is the substantiation for these assumptions? Basically, when we have our month on month or a quarter on quarter sales record, past sales and the past expenses record with us, based on that, our futuristic assumptions for the next 3 years. Whenever we are presenting a deck to the investor, we need to show our financials, current financials, which are past financial 2 or 3 years. Also 3 years, minimum 3 years of projections to understand where we are today and where we are going tomorrow in the next 3 years, and what is that we are going to give back to him, whether it is 3x or 5x for the investment what he is putting in. That is the reason why we showcase the assumptions very clearly defined. That is what is more important for the investor. If you just say in the present performance your growth rate is not very great, but in the projection you are showing an abysmally high projections, the investor will not have confidence in you. It should showcase based on your past performance. Yes, in the past 3 years, I have done month on month 30%. Yes, once the funds are coming in, I can do a month on month 50% increase. That is what you should be able to substantiate with the existing innovation. Post the fund inflow, in the projections, you should be able to convince the investor. That should be realistic, and it should not be overly optimistic. That is where I was clearly mentioning that. When I say data supported, we are already having the spreadsheets which are showcasing our quarterly or month on month maintenance of all of our accounts. Whether the major heads will showcase in the expense sheet for expense and the revenues for the investor. Not all expenses, we may not show the office expenses of 5 rupees, 10 rupees. Those we won't show. As a major head, we showcase to him, this is the burn rate, this is the revenues. So when we are showcasing with the data supported, the investor will get the confidence. Based on that, the scale and the growth, what we have showcased in the projections will be very satisfying to the investor, and it gives him the clear cut the growth pattern which we are projecting. These are some of the mistakes any startups does when doing their financial modeling, revenue projections, because when you don't maintain your month on month or a quarter on quarter projections, the unrealistic revenue projections will come into play. When you does not create those spreadsheets, the ignoring operational expenses. Some people only look at their product development cost. They when from a raw material to a finished product, whatever is the cost involved to develop it, they are only going to consider, but not the variable expenses which we are making. If that is not taken care, then the operational expenses is missed, and your pricing for the product varies, and that's where you will have a impact on your product pricing. That we have discussed earlier also. That is another mistake, operational expenses, which you are saying. Weak or unsupported assumptions. This we already discussed twice or multiple times till now. Because when we don't have these spreadsheets, maintain the tools in which we are maintaining our record on a day-to-day basis, we will have this unsupported assumptions. Because whatever we take into assumption for the future, that if the data is not supported, the investor will think that is a haywire decision which is made in showcasing the projections. No cash flow visibility. This no cash flow visibility, which I was talking about, is when you doesn't have the sales funnel rightly projected. You don't have that. You doesn't know what is the cash flow. You doesn't understand what is the run rate you have. We were talking about in earlier slides about run rate, right? Let me go back to what is the slide number. Yeah, runway. This runway, when we are talking about runway, this is exactly defines how much time you have your money further to run your business. No, when you doesn't have the runway, the cash flow visibility, you will not know how much money is there, whether you can run the business or not, because in order to run the business, you need to have money to buy raw materials, or if it is a service company, you need to pay the salaries for the employees and some of the standard expenses, the realty expenses, rent for the place where you are working. That all those things we need to take care. And if you're not doing it, if you don't have the cash flow visibility, you're not able to support that expenses, and that will be a big challenge for you. Okay, those are some of the examples I'm trying to give, but there could be many other expenses which we need to consider. We need to track on a regular day-to-day basis in order for not getting into a bad state of cash flow, which is not there for us to run the business from in the next couple of months down the line. That is, it's very important to understand what is the runway you have with the cash flow which is available with you. Okay, confusing spreadsheets. As I said to you very clearly, You need to maintain a very detailed spreadsheet on what are the expenses, what is the revenue which is coming in, where it is going. When 100 rupees is coming in, you need to understand where that 100 rupees you're spending on a month-on-month basis and how much you are saving month-on-month to take it to the next month to showcase that, yes, this is the advantage I have because my churn is less. I can do a runway of longer periods. If my churn revenue inflow is less and my churn is more, the runway becomes lower, right? So we need to match this in order to, if you maintain a proper spreadsheet, not a complex one and a very detailed one, you will normalize that and you will know where you are spending more, which can be cut down and all that, so that it will be easier for you to track yourself, and for the investor tomorrow when you're showcasing it, he or she will not get confused by seeing it your spreadsheet, because investor will not see your spreadsheets in the day one. Once he agrees to invest in you, he will definitely do the due diligence. Once he's doing the due diligence, he will deep dive into every single penny of what you are spending, what your income is, and what your expense was. All these things he will look into. It may be he may not be doing it directly. His team will be taking care of all those things. So be very clear on that. It is how is he talking? Why the investor will look at my spreadsheet on that? That is 100% that in the due diligence stage, all these things are tracked. And investor here there is one mistake which is not importantly mentioned, which is the complaints. That is, we just gave some examples. Compliance is one of the biggest thing investor looks at. For any company, compliance is statutory compliances are important. Like the for any company, there is something called PF. If the number of employees more than 7 or something, PF will come into play, ESI will come into play, the professional tax, the other taxes which we need to pay, GST, all these compliances which you need to be complied on as per the regulations of the MCA and other authorities which are aligned with the organism in the startup ecosystem. If you don't maintain those, if you do that mistakes, there are many startups which failed after getting funded because of the compliance issues. Or many startups, after the term sheet is signed, the investor was unable to fund him because of the compliance issues. So be very careful when you are running a startup. You need to take into consideration all these things, not only your expenses, monthly day expenses and revenue inflow. At the same time, the compliance issues also should be taken care very diligently. This is some practicals to build an investor-ready financial model. I hope everybody can see it, or is there a way where I can expand? Mega, is there a way where I can expand this? Too small.
So you can zoom it, like.
Oh, I am not getting any zoom. It's already zoomed now. No, there's no way I can zoom the before slide. Before, yeah. I will read for the first one is keep assumptions transparent, which we already discussed. The tips which we are again summarizing it here. Use clean, simple spreadsheet structures. There is the build monthly and yearly forecast, which we already discussed. Yes. Include multiple scenarios where you in the projection, sales projections or any other expenses. When you do a best case and a worst case scenario, the investor will know, yes, he is doing a right way of projecting the business and not always pessimistic or not always optimistic in doing it. Okay. Regularly update projections. Yes, this is more important when you are doing a projections. When you are submitting a 3-year projections to the investor and the term sheet is ready, signed, and we have got the funding. At that time, we need to be very clear and keep updating him on a quarterly or a month-on-month basis, and update the projections as per the actual thing which is happening. Like our projections were only 50% month on month. Fortunately, we were able to, after getting the fund, we were able to do a 75%. Go increase the projections in the right way, as and accordingly. Or if unfortunately due to some natural issues like whatever we are seeing today in the geoeconomics, if these are the challenges, there could be some impact on the sales. That because of that, the projections may come down. At that time, also go correct your projections. Don't keep the projections as is and go at the end of the year and say, hey, we failed because of these reasons. Geoeconomics, which is not in our hands. Yes, the investor understands. That is the reason it is your duty to upgrade, update the projections on a timely basis. Okay. The final one, align model with the business strategy. Always your business strategy and the model what you're preparing should be aligned. If not, you may talk something, but the figures may show something differently. That is what you need to do. You need to align with your business strategy, work towards it, and make it happen. If it is not happening, you need to apprise the investor or the board in the right time so that they give you remedial measures for that. That is the important thing, which why we discuss about aligned model with the business strategy. Okay. Last slide, I hope. Yes. There are some tools and templates which we can use in the financial modeling. Excel or spread in Google Sheets, one and the same. It all depends on what the product you are using. Advanced tools, financial modeling template, dashboard software, startup financial tools. These startup finance tools or dashboard software, these can be used at a later stage when we are in the growth stage, because in the early stages of startup will not have funds to get into using the dashboard software or the any other startup financial tools. I am only suggesting that do not look into those at this time at the initial stages. Yes, when your cash is allowing you to go for those jazzy things like dashboard software and the startup financial tools. It is not jazzy, it will give you productivity also, but at the same time it involves cost also. So you need to mix and match what is right for your organization to use which tool. Even spreadsheets, if you do it properly, you can use it in a better way. Okay. Useful sections in your model: the revenue sheet, expense sheet, cash flow dashboard, KPI tracking. All these things, when we track it rightly, we are on the right track. The dashboard can show you the right green signals everywhere if you have your revenue sheet or the expense sheet or the cash flow sheet in the right way. If any of these is mismatching, your dashboard will give a red signal, and that's where you need to get ready for corrections. Or else, if you ignore that, one thing, your runway is going to get hit. Your KPI tracking also will have a bad impact. Okay. I don't know whether, because this being a monologue, I don't know whether anybody has any questions and whether I can add question. Mega, if you can take any questions, it will be great. If,
Yes, sir. So, a few of our startups have some questions. So,
yep,
we'll
please.
take here. Like Neeraj have, what financial metrics matter most for SaaS, D2C, and service-based startups?
See, there is nothing specific, as I told here, when subscription model, when you're talking about subscription model. Here, see, you need to understand basically a SaaS company, where if you go by the product method, it will not, there is no way you can make money. So you need to understand, if you do a pay per use model, pay per use can be daily, monthly, hourly. What is that? How much low you can bring it, normalize it, so that the customer should not have a pinch. At the same time, you should not have a hit on your project and profitability. These two are, it should be matched in the right way to take that into the right sense. Neeraj?
Yes, sir. Our next question is.
Huh. How should depreciation and amortization be handled in projections? Basically, depreciation, for every asset, there is the chartered accountants will give us that percentage for every asset. That is a standard thing which is given for laptops. I think it is 30%, and other if there are some plant and machinery. It all depends on how much the value of it and what is the life cycle of it based on the supplier who is supplying the machinery. He will give us the life cycle of that plant and machinery. Based on that, the depreciation can be defined. There is no hard and fast rule that we need to go only with this. Based on the life cycle of the machinery, we can go do the depreciation. It can be 20% if it is 5 years. So, if it, based on the life cycle, you can adjust the depreciation accordingly.
Thank you so much, sir. I think it's clear. Now, our next question is how do investors evaluate EBITDA projection in startups?
This it's very as we clearly told. Basically, when your revenue versus the churn is taken care in a right way, the EBITDA is arrived at. And if the projections are based on the past performance in a right assumptions, the right assumptions, because in the past 3 years my financials shows a 30% increase. First year 30%, the second year 50%, and for consequent years 50% only. Then in my projections, if I showcase 50 in the very first year of investment flow, and in the next year, if I show a 75% and a consistent 75% growth, then that makes the investor, gives him the comfort level that the projections are more or less same, are in line with his past performance, and if data can be arrived at accordingly. That's how we can take a look at that.
Thank you so much, sir, for answering these questions. So we have running out the time. So thank you so much for taking such an insightful and engaging session. I hope today's discussion clearly highlighted to how a well-structured financial model is not just about numbers. It's a roadmap that helps startup community their vision, plan growth, and build investor trust. So we sincerely appreciate your valuable time, knowledge, and expertise shared with all of us today. To all our participants, we hope this session has provided meaningful learning and practical insight to help strengthen your startup journey. On behalf of Gene Cube, thank you so much everyone for joining us today. Have a wonderful day ahead. Thank you.
Thank you.